Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Duke Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Duke Energy is an electric power holding company headquartered in Charlotte, North Carolina. It owns 58,000 megawatts of baseload and peak generation in the US, which it distributes to 7.2 million customers. Its territory covers over 100,000 square miles with 250,000 miles of distribution lines. Almost all of Duke Energy's Midwest generation comes from coal, natural gas, or oil. Half of its Carolina generation comes from nuclear power plants. The company announced it would install 530 electric car charging stations around Florida. Let's get started with the model. This is a large cap company, 65 billion market cap. They're trading at $88 a share and they have 736 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They did have strong net income in 2017, 18, and 19, but it dropped to $1 billion in 2020. Revenue is a sales for the company, and that's pretty consistent. It did peak in 2019 at $25 billion, but dropped to $24 billion in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Example is cost of labor. The difference between those two numbers is their gross profit. They do have pretty consistent gross profit each year, between $10 and $12 billion. Below that is their operating expenses. Examples are insurance and depreciation. Then below that is operating income, and that's pretty steady. It was the highest in 2017 at $6 billion, but it is $5.5 billion in 2020. Below that is the interest they pay in their debt, and then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. The reason they had low net income in 2020 was a negative $2.5 billion in other income and expenses. Most of the negative $2.5 billion is losses from its investments in other companies. I would focus on operating income when looking at the income statement. The stuff below that is not part of their operational business, so it can really skew the numbers. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. This company is aggressively investing back into their business to grow it. That's why they had negative free cash flow every year, because they had so much in capital expenditures. They did have negative free cash flow in 2020. Yahoo did not pick up the CapEx amount in 2020. Since the company has negative free cash flow each year, it needs money from somewhere to run its business. So it issued $1.8 billion of stock in 2018 and $2.3 billion in 2019. It's also issuing a lot of debt each year. The most important part of any business is their operating cash flow, because if you cannot generate positive operating cash flow, you don't have much of a business. And they do generate a lot of operating cash flow. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And the way you calculate operating cash flow, you start with net income. That was $3.6 billion in 2019. Then you have to add back the depreciation of $5.2 billion. Depreciation is a non-cash expense that brings down your net income. Even though they reported $3.5 billion of profit, they actually generated over $8 billion of cash flow. In 2020, they only reported $1 billion of profit, but generated nearly $9 billion of cash flow. Let's look at the capital structure. $49 billion of equity, $64 billion of debt. They're 43% equity, 57% debt. And their WACC is 7.2%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $81 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $67 billion. We divide that by 736 million shares. And we get a calculated stock price of $90. They're trading at $88, so they're trading at a 2% discount. It's a buy, but it's really close. Simply Wall Street values the stock at $140, so they're saying it's really undervalued. They're saying it's a strong buy. It's hard to value a company with negative free cash flow, so I had to look at analyst estimates. Analysts are expecting their free cash flows to grow a lot in the future because they're investing so much in their business now. The stock was pretty steady the last 5 years. It was up and down, but it hasn't moved too much. It peaked at about $100 before the March crash, then came down a lot. It's still a bit below its all-time high in March. This company seems to be raising their dividend each year, and they pay a 4.35% dividend yield. And they pay out 263% of their net income. The reason it looks so high is because they had that big negative in other income and expenses. Annual dividend over free cash flow is a better indicator. The company pays out 32% of their free cash flow, so 68% is left over to invest back into the business. And they have a really low beta, 0.25, so the stock moves 1/4 of the market. The stock has gone down 12% in the past 52 weeks. The S&P 500 went up 17% in the same time frame. The 52-week low is 62, the high is 104, and the stock is trading below its 200-day and 50-day moving average. About 2.5 to 3 million shares are traded each day on this stock. 65% of the shares are held by institutions, and less than 1% are shorted. If you invested $10,000 into this company 10 years ago, you'd have about $25,000 today. Vanguard is the biggest shareholder at 8%, then BlackRock, State Street, Wellington, and MFS. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 60.1, so investors are paying $60 for $1 of earnings. Price to sales is stock price over sales per share. They're at 2.7. Price to book is stock price over book value per share. They're at 1.3. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $49 billion of equity, $27 billion of tangible equity, since they have $19 billion of goodwill on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 2.5 times. ROE is net income over equity. That's only 2%. Current ratio is current assets over current liabilities. They can cover only 50% of their current liabilities with their current assets. And their current assets are $259 million in cash, $3 billion of receivables, and $3 billion of inventory. So the company will need more debt or equity financing to run their business over the next 12 months because they had negative $1.7 billion of free cash flow, negative $7 billion of working capital, plus a $2.8 billion dividend payment. So they'll be short about $12 billion. The best way to look at ratios to compare them to similar companies, I've done videos on Evergy, Hydro One, Alliant, and NextEra, all in the same industry as DUK. And if DUK has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they have the worst PE of all the companies. Price to sales and price to book, they're doing really well. All these companies are doing terrible in current ratio. They're the worst in ROE. They have the most debt and the second highest market cap. They do pay the highest dividend. So to summarize, I have them trading at a 2% discount. This is a really big company. They are generating a lot of operational cash flow, but they're investing so much into their business, it could be a really big stock in the future. I rank their free cash flow as 1 out of 10 because they're always negative. I rank their revenue 3 out of 10. It did grow from 2017 to 2019, but dropped a lot in 2020. I ranked their ratio as 3 out of 10. They do have a good price to sales and price to book, but the other ratios are pretty weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.